Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments, subscribers. I greatly appreciate it. This week, we're going to dive into Kellogg, the giant consumer staples company. It's got snacks, chips, cereal brands, a lot of iconic brands that you have eaten, that I eat. Let's take a look at the stock and figure out what we think it's worth and look into the public market to see what it's trading at and figure out if it's an economic return. You're going to want to watch this episode because it's going to teach you what not to buy. Let's recap the 5 key attributes that we use to analyze all of the companies that we review here in this channel. And that would be top-line revenue growth. You've got to have it. Earnings growth. We look at EBITDA, enterprise level earnings. It must be growing. I need strong free cash flow, low debt. Debt to us is less than 3 times EBITDA. And we need a well-priced stock. Well-priced being enterprise value to EBITDA. It's got to be cheap or at least fairly valued for us to buy it. Now let's take that logic and let's apply it to Kellogg. Okay, behind me is Kellogg's Q4 earnings report and presentation. I want to go through here, look at the brands they have, look at a couple highlights, then we'll dive into the 9-year financials that I have in the past. But let's dive through very quickly their most recent annual result. One thing I want to point out is some of the brands that they own, just to give you an overview of the business. So they own RX Bar. They recently purchased that. That's a very fast-growing nutrition bar company. Good for them. But they own things like Eggo Waffles, Cheez-Its, Crunch Nut, Nutrigrain, and Pringles. These are all, in my mind, very old brands. It's something that they tout. They've been around for 100 years, whatnot. But it's also facing tremendous competition from the e-commerce game and kind of startup brands. And I think these guys need to do a better job trying to acquire businesses, which they've done with RX Bar. But you'll see that RX Bar is nice, but it's not moving the needle. It's just not big enough. But let's keep going. I want to show you this chart in particularly. So this is one of the very first charts they bring up, and they're saying, hey, look, I checked this box and revenue growth 6%. Now, 6% revenue growth for a monster company like this, of a consumer staples company, is a solid number. Don't get me wrong. But this number, I don't believe it's right. So what they're doing here is they're adjusting for some divestitures and they're adjusting for currency impact that happened throughout the year. And you'll see here, the divestiture, they sold off some assets. Well, that's a problem. If you're going to grow, you have to grow to compensate for the sale of assets. So I don't like that. And currency, they're saying, hey, don't punish me because I'm a global company and currency move around. Again, we've looked at a lot of companies in this channel that are all global conglomerates, and they're not blaming currency for weak growth. So I think here, this top line revenue that they're pointing to isn't really fair in my mind. That number is a whole lot less. I'll show you what it is in the 10K in a second. Okay, behind me is the annual 10K filed as of December 31st, 2024 for Kellogg. And I want to show you what they're reporting as top line revenue on their 10K versus what they tell investors they're doing after moving the numbers around. 2020 net sales in millions, $13.77 billion. 2019, $13.57 billion. That is roughly flat. The prior year, 13.55, that's also flat. So they're saying in their presentation, hey, look at us, 6% growth, yeah, rah, rah. They're filing with the SEC and they're just putting it in the file that really sales is flat for the last several years. And that to me is a problem. I think they're showing numbers that yes, you can prove out the 6% by moving the needle around, but honestly, if I'm investing in this business, I'm investing in you to grow the top line that appears here, not adjust for the top line so you can show a growth number. So that's a problem. I also don't like exactly how big this SG&A number is. This $3 billion here, SG&A, that's all management, advertising, corporate ops, rent, insurance, it's the kind of fixed cost that it takes to run this business. This is really large, in my opinion, relative to revenue. That's about 22% of top-line revenue is going out the door in SG&A, and I think that's an area of opportunity that they should focus on to reduce that number significantly, bring that back down under 20%, and that would produce hundreds of millions of dollars that would drop to the bottom line. And I think that's something that management really needs to take a look at. But you can see earnings, net income, they are profitable. fine, but the profitability really isn't going anywhere. Last thing I want to zip to is the cash flow statement. So operating cash flow in the most recent statement, it is positive on the operating cash flow. They call additions to property here, that's their CapEx line. They changed the name a little bit. And I want to show the debt payment. They're making $1.2 billion or $1 billion of debt payments. That's a lot of free cash flow, especially if they made only $2 billion of free cash flow. They got to peel off $1.3 billion just to pay debt. That seems kind of like a problem. They borrowed a little bit more here, so the net is less, but in total, that's a big number that's going out the door. Lastly, dividends. Cash to dividends, $700, almost $800 million of cash that's going out the door for a dividend. All right, now let's go look at them historically and figure out what we think this business is worth. All right, behind me is the 9 years of revenue for Kellogg. Let's take a look. And I was surprised by this. I thought they'd be doing a better job, but 2012, $14.2 billion. 2020, $13.77 billion. That's the number you saw earlier on this sheet. That's a whopping 0% growth over that 9-year period of time, which in my book, better get someone fired. That's pretty atrocious. If I look at EBITDA, so profitability, EBITDA enterprise level, our metric for earnings, right? 2.1 billion, 2.3 billion, extremely weak growth at 1%. You can see it kind of dips down here, kind of comes back, but by and large, it's flat and revenue's flat as well. So this business is not growing like they said in their Q4 numbers, which is correct the way they did the math. What I'm arguing with is the logic behind the math. So they can make up a number of growth to wave in front of the investors for the investor relations department. But you and I, the value hunters, the people who are reading the black and white document in the back, say, wait a second, you're not going anywhere. Let's calculate enterprise value, look at leverage, and then we'll see, kind of recap where we are with this metric. So debt, $6.8 billion to $8 billion. Small creep up in debt on flat EBITDA. No excess cash, market cap $15 billion to $21 billion, so a little bit of market cap expansion despite flat revenue, flat EBITDA. Add these up, I get enterprise value, $22.2 billion to $29 billion. That extra growth here is coming from market cap, but really it's a $30 billion company, owns a lot of stable, cash-flowing brands, so be it. Our debt measure, so net debt, taking total debt less cash, which they don't have any excess cash, divide by EBITDA to get number of years to pay off all the debt. And you'll see here 3.2 to 3.4. It's largely above the 3x that we like to see. So in our book, this is a company that is fully levered, and I would not put any more debt on this business. And to see a business this levered that's struggling to grow the top line and earnings, in my book, is a problem. As new brands come out with e-commerce, it's extremely easy to start a new consumer staple company. As those come out, it's eroding market share and revenue potential from these guys. But this debt is fixed. You got to pay it back. So you got top line pressure from the market, lots of competition. You owe the bank money, that's going to pinch cash flow. We'll see that in a bit. Enterprise value to EBITDA, that's our measure, one measure for value. We look at cash flow too, but this is one measure for value. 10x, as low as 6.5, that seems like an anomaly to me. 10.5x, high of like say 14.5, 15x. Currently at 12 to 13 times, kind of a narrow trading range, and frankly, rich in my opinion. Paying a double-digit EBITDA multiple for a company that's fully levered, not growing revenue, not growing earnings, to me is not something I would ever do. If this thing got cheap at 5, 6.5, I think it's a huge target for a private equity or an activist investor to buy, either take private or start accumulating shares, tossing out management, tossing out the board, and truly be that activist investor. Because their brands are solid, they're positive cash flow, but they've got too much debt, and they kick out a nice dividend, which is sucking up their cash flow. So overall, I'd say that the revenue is a problem, not growing. Earnings are flat. It's 1%, but it's still pretty flat. And there's too much leverage. Oh, and the price to me seems too expensive for the risk of flat top-line revenue. Okay, let's take a look at cash flow. Here we are with cash flow, kind of the same story as we saw with earnings. So 2012, $1.7 billion of free cash flow to operations, to 1.9, call it $2 billion of free cash flow from operation. That's a 2% annual growth rate, slightly higher than the 1.1 in EBITDA, but essentially the same. So what's that telling you? That's telling you that the accounting department is doing an accurate job reflecting cash flow on the income statement, so that's good. What we don't like is it's not growing very much. CapEx to me, again, that was what they were buying in their purchasing of properties, they called it. CapEx is about a quarter of this cash flow, so there's definitely room there. There's free cash flow. It seems like they've got the manufacturing line set up. They got the press making the Pringle chips, making the Cheez-Its. That's all running fine. It doesn't take them a lot of cash to put back into the business. The problem is the debt payments that they have to make suck up a lot of the free cash flow. So this is negative. This is an outflow of $700 million. But that also included borrowing money. If you recall from the cash flow statement I just showed you, this number is really $1.2 billion that they had to pay out for the principal payments of loans, but they borrowed another $500 million so that this net number doesn't look as bad. But really, they need to pay that debt down. You and I both know that because they're above 3x. So this number, in my mind, is artificially low. That means this number here, the cash flow to equity, is too high. If I look at this kind of on an average, it's wildly mediocre. And $800 million, if you added the other $500 million of debt payment that they had to make, they didn't borrow that money, then that almost wipes that out entirely. And don't forget, out of this number needs to come the dividend payment. That's $700 million, almost $800 million of dividend. That's almost 100% of their free cash flow, which means there's very, very little money to save for a rainy day, go out and be acquisitive so you can grow your company, invest in not just maintaining CapEx, but maybe starting a new a consumer brand. There's just very little cash flow here left to do any of that. So let's keep going. Shares outstanding, roughly flat. Why? Because they don't have any free cash flow to buy back shares. Free cash flow per share, it is what it is. Stock price and a yield. Yield is wildly mediocre, low single digits, nothing to write home about, roughly equal to the dividend yield, which is a red flag because it means they're dividending out all their free cash flow. There's nothing really left to kind of play with. So in my mind, this is weak cash flow because of the leverage that they have in place. So now let's forecast this business and see what we think it's worth. So we'll pick up the forecast of 2021. I'm taking 1% EBITDA growth, which is basically what they've had in their history. 1% growing, it's largely flat with a long-term forecast of 2.5, call it $2.6 billion. I've used an enterprise value to market multiple of 12x. That's just the average that they're currently maintaining. Again, I think that average is still too high, but if I lower it to what I would really be willing to pay for it, which would be a single-digit number, it's going to make the numbers look even worse. But let's just give them the average for the sake of this. $2.6 billion of EBITDA times 12 gives me an enterprise value of $31 billion. That's roughly what they're at right now. Less debt, market cap $22 billion. That's flat. So then you've got divide by the shares that's in it, and I get a $65.95 price target for long-term Kellogg stock value in 2030 on the EBITDA market multiple method. If I use the cash flow method picks up with free cash flow. Again, I think this free cash flow is too high because they borrowed to make the dividend payment. That should be lower, but I'm giving them some benefit of the doubt for sake of simplicity. Here, grow it at 1%, $2.58. I give an average yield of 5%, which is okay for a slow growing company. And I get a $51.57 price target. Okay, now we have two price targets. We've got one from the EBITDA market multiple, and we've got one from free cash flow. That's here. I'm going to average the two because I don't know really where it's going to happen. I get a $58 price target. I then, for the very first time, go look in the stock market, pull up Yahoo Finance, Google Finance, whatever you use, figure out what the price is. It's $63 roughly. Well, if you can buy it at $63 and you just said you think it's worth $58 a decade from now, that's not going to look good. If I put this in an IRR calculation, I'm buying at 63 bucks. I get this pro rata share of cash flow, which again, I think is too high because they borrowed money to make the dividend payment, but it is what it is. Out at 58 gives me a 4% IRR. That is roughly the dividend yield. It's a little higher than dividend yield, but I think the reason what you're seeing here is a very subpar IRR. And that's largely due to the cash flow being limited and the weak growth of revenue and EBITDA. You know, you think the market would do an average 10%. I'm showing you stocks that I think will do 15, 20%. And you're going to allocate your capital to a business like this that roll the dice, that maybe they turn it around. Maybe they find the next acquisition that becomes the rocket ship to take the business up. That's kind of a big stretch. If they haven't already done it, why would they be able to do it in the future? So for me, what we're going to do is we are going to do an ugly. I think it's an ugly investment. It's not going anywhere, hasn't gone anywhere for years. They're over-levered. They don't have free cash flow to grow. It doesn't check any of the boxes. Let's take a look at the distribution for our stock chart, just for fun. As time passes, this stock price is going to move. Currently 63 bucks. It could go up, it could go down. This gives you a distribution if the future stock price pans out. This is the distribution, nowhere near where we need to see it, so we're going to pass. Let's recap our 5 key attributes here. Top line revenue growth is not growing. EBITDA growth is growing. I'll check the box. It's 1%, but it's barely there. Free cash flow is not there because of the debt payments are too high. Too much debt. It's above 3x, and it's not well priced. Given all of those, it should be a mid-single-digit EBITDA number, in my opinion, for what it's trading at. So I think this is a hard pass. What I do want to show you is what I think that this is a candidate for. Is this stock is a candidate for a takeover by a private equity company or an activist investor that can shake up management. And what I think could happen, well, no, I don't think it's going to happen. And what I would do if I had the money to go buy this company, I would take it private, because the one thing private equity likes, and I'm going to share this with you, one thing they like is they like stability of cash flow. And that is stability. It's not growing. That's the private equity job to figure out how to grow it. But what they want first is stability, because stability means you can put a lot of debt on it. Now the company has already naturally leveraged it, but private equity groups have connections with other lending institutions that can add even more debt on this company. So what they would do is they'd come in here and say, well, it's currently at about a $20 billion market cap. I'll add a small premium. Let's say it's 20% premium on top of that. That's about a $25 billion market cap that they would go out and buy that company and put down the cash. But they would go to a bank that they have connections with and say, look, you trust me, I can run the business, give me more leverage on this company so I don't have to come out of pocket for all of this cash. And the bank would say, well, they're not growing, but this is pretty stable. They've got good brands. Okay, I'll give you another couple turns of this EBITDA. So they might be able to get another 2 to 3 times EBITDA out of this, which 3 times would be almost $8 billion of cash that the private equity company could borrow and not have to put out the full 25. So then they would take this business private. They would look into the P&L, like I showed you earlier, look at the SG&A, and they would streamline it. They'd cut back. They would use technology, new ERP systems to run these brands, and they would go out and they would acquire. And they would acquire by not making the dividend payment because they're private. After several years of making interest-only payments, so they're not have to make the principal payments. Instead of that $1.2 billion of outflow to pay down the principal, it would just be interest only, and they don't have the dividend payment, so they would have maybe $1.5 billion of free cash that they could use to go acquire companies and grow brands and retool the business. With the idea being that this EBITDA number over the 5 years it was private, they would grow it, try and double it. And then they would take the company public, having shown 5 years of hopefully improved EBITDA growth, relaunch it at a new 12x multiple or whatever it is on a doubled EBITDA, and you'd get 2 times the market cap. It could go for $50 billion. And then you have a growing company that you can take public, and it's a much better story that investors can climb onto. That's what private equity does. That's how they do their business. And they take companies like this that have a solid brand history, but might just need a little touch up when it comes to management to really take this business and make it shine. So again, we're hard pass at this channel because we obviously don't have $25 billion of jack to go take the company down. If you do and want a CFO, call me. But I think this business is a pass. There's way too much other stuff out there that is fantastic to put your money in. So I hope you like this channel, this review of Kellogg. My name is Cameron Stewart, CFA. This has been Rational Investing. Please hit the subscribe button or comment. Let me know what else you want to see down below. Take care. Bye-bye.